Thank you for joining me for the second module of our Opportunity Zones Masterclass. And by now, you might be starting to put the pieces together on how an OZ strategy could be integrated into your personal wealth creation and tax planning strategies. In this segment, I want to cover the following. Number one, the window of opportunity to take advantage of the OZ legislation. And number two, when you should consider a 1031 exchange versus an opportunity zone. And number three, I want to take you through some specific case studies that'll help you address the question, should I go ahead and pay my taxes now if I think tax rates may be going up in the future? This is going to keep us busy for a while, so let's buckle up and make sure you have something to take notes with. So what exactly is the window of opportunity for investing in OZs? As it stands now, investors have until December 31st, 2026 to invest in a QOF or Qualified Opportunity Fund. Democrat Congressman Ron Kind of the House Ways and Means Committee has introduced H.R. Bill number 7467, which would extend the OZ investment opportunity until 2028. Suffice it to say that whether it's 2026 or 28, the window will close on this important tax and investment benefit for both long and short-term capital gains. And by the way, if you subscribe to our updates, we'll keep you posted on this and other opportunities that you might find relevant to your investing and planning needs. As it stands now, we've seen no changes to the 180-day rule to invest your gains and defer your taxes in 2026, generally considered payable in 2027 for most taxpayers. By the way, if you subscribe to our updates, we'll keep you posted on changes to this opportunity and any others we may find relevant to your investing and planning needs. I want to add that if you're a CPA who's watching this masterclass, I want you to tell us if you'd like to attend a special class on this topic for CPAs where you can earn CPA CE credits. Our firm has participated in such events and we can be sure to get you a seat in an upcoming class. Keep in mind, this masterclass is geared more for investors than CPAs, and it does not offer CPA CE credit even if the attendee holds a CPA designation. My experience is that most CPAs have heard about OZs and some are interested in learning more, but few that I've met have more than a cursory knowledge and understanding of the intricacies and nuances of exactly how OZs work. If you are an investor and you have a CPA who's taken the time to educate you on this important strategy, then I would say kudos to you. You have a great tax advisor who took the time to learn about something that could potentially have a big impact on your wealth creation strategy, and I would stick with this CPA for the long haul. Unfortunately, however, many CPAs are burdened and bogged down with the heavy load of tax preparation and compliance, and some just don't want to invest the time it takes to learn new things, or they're unaware of the strategy altogether. So if you want or need someone in your corner who can give you proper tax counsel, let our team know. We'd be happy to refer you to a CPA or a qualified tax advisor who makes education and learning a priority. Now let's talk about when it might be best to use a 1031 exchange and when it might be best to invest in an opportunity zone, because this is one of the most valuable insights an investor can get from this class. When I'm counseling with an investor with a cap gain, I'm usually asking questions such as, what is your basis? And remember, your basis is your original cost plus capital improvements minus depreciation. What is the amount of your capital gain and what is the date of your capital gain? Your capital gain equals your gain plus unrecaptured Section 1250 gain, which is a provision in the tax code where previously recognized depreciation is recaptured in an income when a gain is realized on the sale of depreciable real estate property. Depreciation recapture is currently taxed at 25%. Is your capital gain from real estate and did you have debt on the property? I ask this because we may need to discuss using a 1031 exchange and a DST with sufficient debt to cover your debt replacement requirement, particularly if you know you want to roll all your sale proceeds over and if you desire immediate income, which can be an advantage of a 1031 and DST over a QOZ. Do you have any passive or suspended losses currently on your 1040? I ask this question because it might make sense to skip both a QOZ and a 1031 DST and use your sale as an opportunity to carry forward those suspended losses that may be worth only $3,000 per year to you now. What is your age, and do you need income now? And when I ask your age, I'm not trying to be nosy. I'm asking to better understand if you may be more in a growth or an income mode right now with your investments. You could be in both, and we need to talk about how conservative or growth-oriented an investor you may be. All of this information is paramount in knowing which direction or strategy could best serve an investor's needs. Here's a classic example of when I might advise someone to not use an OZ strategy and to opt for a 1031 exchange instead. Let's consider the hypothetical case of Tom and Jill, who recently turned 70 years old and have a portfolio of 5 rental homes that they're considering selling in a very attractive market. They want to move to Texas where they can be closer to their grandchildren, who are just now at the age where they can really enjoy some quality fun time together. Tom and Jill are getting tired of dealing with the terrible T's, tenants, toilets, and trash, and they've learned recently about the 1031 exchange in tandem with the DST, which are income-producing passive investments that under certain conditions can qualify for a 1031 exchange. The DST investments offer immediate income from institutional quality assets with no personal liability, no work, and total freedom from all of the aspects of being a landlord that they were accustomed to. Tom and Jill needed the income from the rental properties to supplement their Social Security and their future RMD portfolio withdrawals. They have about $1 million in IRA assets, so they have plenty of liquidity should they need it. Tom and Jill's primary concerns were deferring taxes now, preserving their family's step-up in basis on their real estate portfolio, and solving for immediate income. They had also heard that opportunity zones could shelter taxes and that OZs also invested in institutional quality real estate assets. So they wondered which would be a better option for their needs. Again, this is a hypothetical example, but I get this sort of real-life call every week. And in a case like this, I'd tell Tom and Jill that the OZ is clearly not a good choice for 2 reasons. First, OZs generally do not provide income for several years because OZs are development deals. There is no income being generated in these assets to new investors because the assets must first be built, then stabilized. Second, OZs are development deals and are subject to additional risk that are not common to stabilized 1031 exchange DST investments that can pay out income now. In a case such as for Tom and Jill, there simply would not be justification for them to take on additional risk and forego income now that could cause them to reduce their lifestyle or prematurely drain down their IRA accounts. A good advisor in this arena must know their client's life situation, needs and goals, and cannot operate effectively from a vacuum. For this reason, it's important that after you become comfortable with your advisor, you should share information about your entire financial picture. You should be concerned if your advisor doesn't ask you a lot of questions about your financial needs and circumstances surrounding your goals, assets, tax situation, and income needs. It's only in this context that an effective advisory team can bring someone the real value that they may need to effectively navigate this important tax, income, and investment landscape. If an advisor is not asking you these sorts of questions and is more intent on pitching a certain investment, it might tell you something about the motivation of the advisor. James is 48 and was a serial entrepreneur. And by the time I met James, he had built and sold 3 companies and had negotiated licensing agreements with several others. His licensing agreements would provide for his income for the next 20 years, and currently, James was looking at the possibility of starting a new company in the software